I'm Jenny Kassan. I'm the CEO of Cutting Edge Capital, and Cutting Edge Capital works with social ventures to raise money in a way that fits with their mission and goals. What we really like to help social ventures do is to design their capital raising strategy in a way that really fits with what they're trying to achieve and with their long-term goals for their business. And what we found is that one way to do that is to really open up the potential pool of investors beyond the typical, what they call accredited investors, which is a federally defined category of investors, which are investors that have over $1 million in net worth or over $200,000 in annual income. We help our clients do the regulatory work that allows them to actually open up their investments to the entire pool of potential investors. So instead of just reaching that 3% that meet the accredited definition, we help our investors go out to the entire pool of 100% of potential investors. There are a lot of regulations governing investment in general. Even if you are just going after only wealthy accredited investors, even still there's quite a few regulations you have to follow, and people are quite confused about those. Even some lawyers often make mistakes. They call this area of law securities law, and it is pretty complicated. It comes from the early part of the 1900s, and it hasn't really evolved to fit the new reality where you can now reach a lot more people, for example, through the internet, through networks. And so the lack of understanding about the regulations is a really big problem. Also, a new law was passed about a year ago in April 2012 that changed some of the laws, so that's adding some confusion as well. But the great thing is that once you do understand the laws, it is actually possible to tailor how you offer your investment to your needs. Generally speaking, there obviously are some limits and some costs and onerous regulations that need to be complied with, but it is certainly possible to find a pathway through all of that to do what you want to do. And I go around speaking about the issue quite a bit, trying to explain it in layperson's language. I didn't start out as a securities lawyer, so I didn't learn about securities law until about 11 years after I graduated from law school and took the bar. So I really understand what it means to not know anything about it. I ask people oftentimes, have you heard of the concept of an accredited investor? And most people haven't. Most people don't know anything about it. So I think just really spreading the word about the basic system and then starting to have some examples of success stories. We've had several clients who have used the existing laws to raise capital from their community, their customers, their fans, affinity groups, and they've done it successfully and legally. So just starting to show some examples of how that is actually happening now. One success story that we have is a small business called Quimper Mercantile. This was in Port Townsend, Washington, and it's a small community that didn't really have a place to go to buy basics, things like socks and underwear. And they didn't want to have to drive to the big chain store to buy those essentials. So the community got together and said, let's create a community-owned store. So a steering committee got together, created the business plan, and we helped them through the regulatory process to allow them to sell stock to their community. So they sold common stock. The minimum investment was $100, and they actually ended up with over 1,000 investors. They raised several $100,000. They raised enough to reach their goal and to actually open the store, and the store is now open, and it's a community-owned store. I think crowdfunding is a term you could use for that. I think sometimes I shy away from using that term because I think that term is used for many, many different things. So I don't like to cause confusion by using that term, but I think absolutely it's a form of crowdfunding. We have a client called Farm Fresh to You, which is a larger established business. So unlike Quimper Mercantile, they are an existing business with about 60,000 customers, and they deliver boxes of organic produce throughout California. And they wanted to raise some money just to be able to work on some new projects within their company. So we helped them do the regulatory work that allowed them to raise money from their customers. The minimum investment is $2,000, and in their case, what they decided to sell was a note. So it's actually a loan. So that's one of the nice things about this way of raising money is you can really design whatever you want to design. And so they sold a note to their customers and raised several $100,000 that way. way. And the interesting thing is that the interest is payable in produce. So they don't actually have to pay cash to their investors, they're actually paying them back in credits towards the product that they sell. So it's a really affordable way for them to raise the capital that they need. And they actually just renewed that offering. They renewed with the regulator so that they could just keep going. And they can renew every year and just continue to use that as a source of capital that they can, turn on and off whenever they need it. That's probably pretty unique, but the more we work with clients on different kinds of capital raising from the public, the more we hear about really new, interesting ideas. We have some clients that sell preferred stock, but along with the preferred stock, you also get a discount card at the business, so you can get really, really creative. And the more we work on these projects, the more we can give our clients lots of different ideas about how to create a securities offering that really fits with their long-term goals. So the Jobs Act was passed about a year ago in April 2012, and it made quite a few changes to the securities laws. One of the changes it made is a subset of the Jobs Act, which is called the Crowdfund Act. And what the Crowdfund Act will do when it goes into effect is it will allow people to raise money from the public up to $1 million per raise. And as long as every investor isn't putting in any more than 5% of their net worth or annual income, it will be allowed to be done under this exemption. It hasn't gone into effect yet, and we're still waiting for the Securities and Exchange Commission to do rulemaking on this. So we really don't know exactly what it's going to look like. One thing we do know about it is that you won't be able to go out and sell your offering directly to the public. You'll have to just refer people to a registered intermediary. So this will just add to the ways that people can raise money from the public. What we're doing is similar to that. The biggest difference between what we're doing and what the Jobs Act will allow is that in many cases you can raise more than $1 million. There's really no cap on the per investor amount, and also oftentimes there's no requirement of audited financials or reviewed financials, which probably will be required under the Jobs Act. Also, in what we do, we have to register in each state. So under the Jobs Act, you'll actually be able to raise money from people in all 50 states, but in the process that we do now, which is currently legal, you do have to register in each state. So most of our clients only raise money from maybe 1, 2, 3, 4 states, because it does get to a point where it becomes quite onerous if you're doing a lot of states. So Kickstarter and Indiegogo are another form of crowdfunding, and the big difference between those and what we're doing is that you're really only allowed to offer the opportunity to make a donation or a gift. The minute you offer any kind of investment opportunity, which is called a security, any kind of return on the investment, whether it's just a promise to pay something of value in exchange for the donation, you are potentially falling under securities laws, and then it's illegal. So everything that happens on Kickstarter and Indiegogo needs to be just donation or gift-based. It could be a tax-deductible donation if the business that's raising the money is actually a tax-exempt 501c3. Oh, that's a great question, because I was actually involved in the beginning of the Jobs Act coming to be. So back in 2010, I have a nonprofit called Sustainable Economies Law Center, and we had summer law student interns, and we decided to discuss the issue of the fact that the securities laws make it so hard for regular people to invest in businesses that they might feel good about. So we said, why don't we write a letter to the Securities and Exchange Commission and request an exemption for very small investments. So what we said, we actually wrote the letter. The interns spent quite a long time making very good arguments about why it made sense to create an exemption from the securities laws when the maximum amount that each person was investing did not exceed $100. And we felt like that's such a no-brainer. I mean, really, does the SEC need to protect people from putting $100 into a company that they feel good about? So we actually did not get a response from the SEC on that. We did get a lot of letters of support sent in for that idea, but the SEC kind of just didn't do much with it. But the word got out among the public, and a lot of people started talking about this idea, tweeting about it, writing about it, Facebooking about it, and amazingly enough, it got the attention of the White House. And the White House then said, we support the idea of creating an exemption for small investments, if people are only putting in a small amount, each individual investor. And then Congress actually got in on the act, and they passed a law to actually create an exemption for these small offerings. And then what we ended up with was the Jobs Act, which was great, but I have to admit that what they finally came up with was a little bit different from what we hoped it would be. The maximum that they set was 5% of your net worth or annual income, which is much higher than $100. And because of that, they added a lot of additional onerous compliance requirements. And like I said, we still don't know exactly what it will look like, but I think it'll be a little bit harder to use than what we had originally hoped. But hopefully it will add a good tool to the toolbox. I actually signed the original letter requesting that this exemption be put into effect. Well, I mean, I think a lot of people don't even really question why it's really not an option for 97% of the population. Approximately 97% of the population is unaccredited, and therefore the only real option they have is to invest their money in a company that's listed on the stock market. Because if you're a big company, you do have the option to go public, and by going public, all of a sudden you've done the compliance work that makes it possible for the general public to invest in your company. So most people, when they're thinking about what to do with their money, even if they would really like to make an impact investment, it's just not really an option for them. They might be able to invest in a public company that's a little bit more socially responsible than your average company, but generally speaking, they're really limited to companies that are Wall Street publicly traded companies. So that's what we're really working to change. We're really trying to spread the word that it is actually possible for companies and even nonprofits to go through a compliance process that allows them to solicit investment from the public. And there are many companies that are doing this now. RSF Social Finance is one that has actually gone through the regulatory process, and they are now offering an investment opportunity on their website. The minimum investment is $1,000. Many of our clients that I described are doing this, so we're really hoping to see this become much more widespread so that regular investors can start to see this as a really meaningful alternative to putting all of their money into the stock market, because a lot of people are starting to question, is putting my money in the stock market consistent with my values? Is it really safe? Because we've seen the stock market look more and more like kind of a crazy casino with a lot of the automated trading and trading done by algorithm, by computers. We've seen flash crashes. So people are starting to really feel nervous about the stock market and wanting a way to keep their money close to home, benefiting their own community, creating jobs in their community. So we're really hoping that this starts to become a more widespread activity. Also, a lot of people don't know that it is possible. You have the right to invest your retirement funds however you want. You don't have to only put it in a mutual fund on the stock market. As long as you set up something called a self-directed IRA account with a custodian, you can put your money into any investment you want. So if a company does the regulatory work that allows them to take your money, you could take some of the money out of your retirement account and invest it in that company. Yeah, I think we've just been living with a certain system for so long that it's really kind of hard to get the word out that there are these alternatives available. Also, there was a long period where it was pretty easy to get capital. So startups and entrepreneurs had a lot more options. They could maybe take money out of their house. That was very easy to do for a while. They could get credit cards. There was a lot of activity with investing in business, and it was, capital was fairly cheap and easily available for a while. So I think we went through a period where people didn't feel like there was a real need to look at alternatives. But now we're in a time where things have completely changed. It's very hard to get capital for your business. Also, a lot of entrepreneurs, because capital is so hard to get, when they do go to an angel investor or venture capitalist, basically an accredited investor, oftentimes the terms are very, very unfavorable. And the investor is expecting them to grow very quickly at all costs, and that may not be consistent with the goals of the founder of the company. So I think a lot of entrepreneurs are really starting to say, I really would like to find some alternatives. And we really like to tell them, there are these alternatives available. You do have to go through some regulatory hoops to be able to use them. But once you do that, it opens up a much larger pool of potential investors who may be a lot more supportive of your goals and may not be asking to sit on your board and dictate what you do with your company. It's a great question. We see a lot of talk about the need to open up the capital markets to a broader pool of potential investors. There's a real demand on the investor side for more options and a real demand on the entrepreneur side for more options. So I think we are very close to a tipping point. It's hard to say what exactly will make that happen. But what we're just trying to do is one by one create these opportunities. When we first started, there were really none. We've now completed 7 in the last year, and those are all still accepting investments. We have them up on our website, and we just are, we would like to do as many as possible and get to the point where we just see hundreds of these out there and people start to really see it as a viable place to put their money. Also, we're trying to create a lot of additional infrastructure to support these kinds of investment opportunities. So one thing that we've done is we've applied to the SEC for a license to create a secondary trading market for these kinds of securities. So we're hoping that sometime later this year that will actually be available. That, for example, let's say you invest in Quimper Mercantile. You live in Port Townsend, Washington. You've invested in Quimper Mercantile, and you really need to get your money out because you just found out your kid needs braces. Ideally, you should be able to go onto the secondary trading market and sell your stock just to another investor that also wants to invest in Quimper Mercantile. So we're working on things like that to really create more of kind of the ecosystem that will support these kinds of investments. So hopefully that will create the tipping point. We're actually working with a wonderful marketing and branding company called Free Range right now on creating a video. So we're really hoping that will help. We go around talking about it all the time. There's also a company called Mosaic that was here at the conference. They have really done a great job of getting the word out about these kinds of investments because they're also offering an investment to the public, and they've been able to really, get a lot of public attention. So I think it's just some of these success stories, and it is still so new that it's hard to tell complete stories. We can say, oh, they were able to raise this much money, but we're not far enough down the line that we can say, and their investors got a great return and everyone was happy. Unfortunately, it takes years to be able to tell the full story of what happened. So hopefully, as these things continue to grow, we'll be able to start telling more and more stories about companies that use this method of raising capital, were able to pay their investors well, kept their values intact, did not get pressured to sell out to a big multinational corporation, kept their company going on the same trajectory, grew at the pace they wanted to grow, and everyone succeeded and benefited from it. Most of the companies that you hear about that are doing this kind of work are really focused only on accredited investors. So those are definitely out there, and that's wonderful. But there really aren't a lot of people focusing on this larger market space of going out to all investors. So right now, I can barely think of any companies other than ours, Mosaic, RSF Social Finance, and of course our clients that are actually doing this. Unfortunately, it's still not super widespread, but I think it is happening more and more. When the Jobs Act goes into effect, or the Crowdfund Act goes into effect, I think we'll see a lot more, hopefully, if the regulations aren't too onerous. So, it is still very unusual to see these things happening at the public level with unaccredited investors. We're not exactly sure why that is, because we've been doing this now for a while and it's really not that difficult. It's not rocket science. So hopefully it will just start to become a lot more common. So under the tools that we use, there is no maximum. Each compliance pathway is a little bit different. There's different federal laws and state laws that we use to make this all happen. So sometimes there may be a cap on how much the company can raise. Or in some cases, there may be some suitability requirements for investors. In California, there are some suitability requirements if you're investing $2,500 or more. They're much lower than the accredited investor standards, but there are some requirements there. So sometimes there are some limits on who can invest how much and how much the company can raise total. But under the current law, there's really no maximum on how much an individual can invest. Although there is one exception to that, and that is sometimes in California, they do say they don't want you to invest more than 10% of your net worth. Well, I do like to start by explaining the law. I'm not sure if that's always the best approach. Sometimes people's eyes glaze over and they don't really want to know about it. But because I went to law school and I didn't know about it, and it took 11 years out of law school for me to know about it, I feel really strongly that people should know about it and be empowered in that way. And it's not that complicated. The basics are not that complicated. So what I like to start out doing is explaining the basic securities law framework, and then talk about, given this framework that we're currently living in, there are some pathways that can allow you to raise money from the crowd, from the public, from unaccredited investors, and here's kind of how those pathways work. Here are some examples of companies who have done them. I also like to talk about not just how can you legally raise money from the crowd, also what types of investment offerings make sense for you. A lot of entrepreneurs kind of go down a certain pathway. They say, oh, I'll sell convertible debt. That's a very common thing to sell as a startup company. And that may be appropriate for you, but there may be some other type of security that's more appropriate for you. There are a lot of people talking now about new kinds of securities that are more creative. For example, securities that have to do with revenue sharing. So that's actually something that we're offering right now. Cutting Edge Capital, my company itself, is doing a direct public offering of securities right now. We're taking our own medicine so that we can say we've done it ourselves. And what we're offering is a revenue sharing agreement. So it's actually neither equity nor debt. It's just the right to receive a percentage of revenue, and the percentage is based on how much you've invested. And you receive that percentage for 5 years. It's a percentage of our gross revenue. So you may not get back your original investment, or you may get back your original investment plus a lot more than that, all depending on how we do. So you just get a percentage of our revenue. So that's just one example of a creative kind of security. You know, our client that sold debt where the interest is paid back in credits towards their product. Preferred stock that cannot appreciate in value. That's another very creative tool that's being used to prevent that pressure for a sale to a larger company. So we really love to educate entrepreneurs about all the options they have when they're selling a security. They just need to find something that fits with their mission and values and goals. And of course, they need to find something that will sell. You know, you don't want to offer something that's so favorable to your company that no one will want to invest. But we've been amazed. Our clients are generally offering what many would consider to be relatively low returns. People's Community Market is selling preferred stock, non-voting preferred stock that cannot appreciate in value, and they're offering a 3% annual dividend that you may not even receive any of the money for 7 years. It's a cumulative dividend. And many angel investors, sophisticated investors would say, that's crazy, you know, and this is a startup company, so it's a fairly high risk investment. They don't even have a location yet. But they've raised hundreds of thousands of dollars from the public because a lot of people who are regular investors don't have that many options right now of where to put their money. And they really feel strongly that, hey, you know, 3% isn't that bad. And if I invest in this, I can do something that I feel really good about. I also get a discount card for the store. So we're finding that you don't need to offer a super high return to be able to raise the money that you need. Definitely. I think a lot of people are thinking about, where's my money, sleeping at night. And there's a big movement for shop local. Shop local is, a lot of people are thinking about, where am I spending my money? Where is my money going? And then, you know, they're adding to that question, what about invest local? The little money that I have to invest, and you know, the average American, I think, has about $10,000 total in their investment account, and that would include, you know, their retirement account, any other investments they may have. where is that going? Who is that benefiting? Is it staying in my community, creating jobs, building infrastructure, or is it flying out of my community and doing something that I may not feel very good about? So I think more and more people are asking those questions. The Jobs Act already contains many things that will make it difficult for people to use in practice. I mentioned the requirement of reviewed financials. If you're raising over $100,000, you will have to get reviewed financials. And I don't know if Congress realized when they added that provision to the bill that reviewed financials can cost thousands and thousands of dollars. So they also have a provision in there that says if you're raising over $500,000, you will have to get audited financials. And that there's some discretion on that one with the SEC. They might not put that in there, or they might. But audited financials are incredibly expensive. Also, the fact that you have to go through an intermediary, I think a lot of people won't feel comfortable with not being allowed to talk to their potential investors at all. The law actually says you may not talk to potential investors. All you can do is refer them to this intermediary website. So I think there are already things in there that will make it difficult to use, but I think there's also a lot of leeway for rulemaking, and I have the feeling, knowing the SEC, that they will add a lot of additional rules that will make it even more onerous. So we may find that it's really not usable for many people. Also, a lot will depend on who will these intermediaries be. I've heard that there are about 1,000 websites out there that are waiting for this to go into effect so that they can become a registered licensed intermediary. And the question is, who will get licensed? Will the SEC give 5 licenses? Will they give 100 licenses? And who will these licensees be? Will they have a good business model that will that will add value for the entrepreneurs who are trying to raise money? So I think there's just really a lot of questions that are hard to answer. I'm not super optimistic about it, but we will see. And when I graduated from law school, I actually went to work for a nonprofit community development organization, and I was there for 11 years. And a lot of my job involved working with very small businesses in a low-income community in Oakland, California. And I came to really love small business owners and really admire what they did, and also really see how they struggled with all the regulations on what they were doing. Every day they would get 5 pieces of mail that they could barely understand, because many of them, English was not their first language, and they were very complicated rules and regulations that they had to comply with. So I became very passionate about helping small business owners succeed, and I really saw how they were giving back to the community and reinvesting in the community. So after 11 years at that nonprofit, I had the opportunity to join a law firm. I met John Kadovich, who's a really legendary attorney. He has lots of experience in the capital markets. He had been the chief counsel at the Pacific Stock Exchange. He had been with many exciting startups. So he had just lots of experience in both public and private financing, which, as I said before, I knew almost nothing about. So he allowed me to join the firm even though I had very little experience working in private sector financing, and I became very passionate about learning about these laws that I felt were quite unjust, because they limited so much who could invest in businesses that they cared about. And the fact that there's this kind of arbitrary line between someone who has $1 million and someone who has less than $1 million, that says, oh, if you have $1 million, you can do whatever you want with your money, but if you don't, sorry, you pretty much are stuck with the stock market. So I learned a lot about the laws, met more wonderful entrepreneurs that were struggling with the way things were being done, and it wasn't working for them. So I just really became passionate about developing tools to help them, and it's been really fun. Sure, I'm really excited about the future. I think it's exciting and scary, because our current financial system, I think, is based on a lot of assumptions that may not be true. There have been a lot of articles written lately about how the valuation of a lot of companies on the stock market are based on the assumption that we can burn more fossil fuel than we can actually burn. The whole stock market is based on the idea that we can grow forever indefinitely, that resources are unlimited, and these things just simply aren't true. So on the one hand, that gets me very excited because I think more and more we will be switching over to more sustainable investments in our own community, in our own backyard. I also worry a bit that it will be a rocky ride as we make that transition. But I think it will be, in the long run, for the best as we start to move our money into things that really matter and things that are real and not just sort of made up based on things that aren't really true. So it's an exciting time to be in this field. I'm Jenny Kassan. I'm the CEO of Cutting Edge Capital, and Cutting Edge Capital works with social ventures to raise money in a way that fits with their mission and goals.